Hey everyone, Rob B here with Rob D, and you know it, you're listening to the Property Podcast. Now this week we're discussing the total return formula. And I'm going to be blunt. If you don't understand what the total return formula is, or you know what it is, but you've not been using it day to day, well then you're missing out. You're missing a key piece of information from your property investment world. So this week it's critical that we put this at front of mind for you so you can start using the total return formula immediately on your current investments and your future ones.
Welcome to the Property Podcast, where every Thursday morning property investors come to be informed and inspired. It's not every week that we can give you a brand new tool to make you a better property investor, but that is exactly what we're doing today. So make sure you stick around and do wait all the way to the end, where we've got a great book recommendation for you as well.
So Rob, it's time for our news story of the week. And the big news story is there is no news, well, sort of, around interest rate movements, because last week, on the day of the podcast going live, the interest rates were predicted to move, predicted to increase for the first time in a long time, and it didn't happen.
Yes, widely predicted that the Bank of England would decide to raise the base rate from 0.1% up to 0.25% as a result of inflation really picking up. But they made the decision not to do that. They seem to be saying, well, it's close, we were thinking about it, but it's a bit too early, and now they're heavily hinting that they're going to do it next time, which of course is exactly what they did last time. So who knows if that's going to turn out to be correct or not. I think for me, Rob, there are 2 points coming from this. Firstly, let's take a moment to reflect on how bonkers it is that the base rate is at 0.1% and they're thinking about whether they can raise it slightly and whether that's going to be okay or if that's going to cause problems for the economy. Interest rates have been so low for so long that maybe this seems normal now, but it is pretty bonkers. And the second thing is that they think inflation is going to peak at 5% next year. Their mandate is to hold it at 2%. If they're not acting now and they don't think it's the right time, when are they ever going to do anything?
It's really interesting, and I think you're right. It's good to stop and just reflect on the economy as a whole, because it just shows how volatile they feel things are, because everything is booming at the moment. It's not just property prices going up. Every asset class is pretty much going up in price. When we look at the data around the general economy, things are really motoring. And if you just got out of a time capsule and you were presented with all the data of today and you weren't told anything about the previous 2 years of what's happened and were just told that this is the state of play and you had to control interest rates, you probably put them up by 0.5%, because everything is motoring so strongly. I think it's that nervousness of what's gone before, and they feel like the slightest knock could send us all off course is interesting at the very least. It's something that you can just forget about because, you know, interest rates is not something that dominates most people's thoughts day to day. But I think it's fascinating that they feel that way. They've not said that, but I'm interpreting that's how they must feel. For why else would they not raise interest rates based on all the data available? So it's going to be interesting, pardon the continuing pun, to see how they react next time around. Because if all the data trends the way it is, continues to go that way, then can it only go up next time around? This time I said I wouldn't be surprised, didn't predict it, just wouldn't be surprised. But next time I would be surprised if interest rates didn't rise. Maybe, Rob, this was just the warm-up to get us all used to the idea, and they've just been very clever, and next time it actually does go up. Maybe we can give them credit for that, and that's what they've done. They've just made us think, how can it not go up? And we'll all be used to it, and nobody will bat an eyelid when it happens.
Well, Rob, the Bank of England might not be making any moves, but we certainly are. Lots of excitement going on here as we ramp up for the launch of Portfolio.
Yes, we are so close now. So close that you all should officially go into I'm getting excited mode. Yes, Portfolio is on the verge of launching. And for those who've joined our waiting list, you are going to find out first. So go to portfolio.co.uk and you can join the waiting list there. For everybody else who's just generally interested and wants to find out, I'd say this is a good week to keep a close eye on our social media channels, because between now and our next podcast, there may be news. But of course, we'll bring you news and updates on the podcast next week.
How well is your property investment performing for you? Or if you're considering making a purchase, how well is that property going to perform for you in the future? The difference between an amateur and a professional investor is the amateur would say, oh yeah, things done pretty well, whereas a professional will be able to give you a number. But there are multiple different numbers you can use to calculate the return that you make from a property investment. We've talked about several in the past and we've given our favourite, and we're going to recap all of those today. But we're also going to introduce a new figure called total return. So this episode, you're going to learn what it is, how to calculate it, and what it can do for you.
But before we get into total return and why it's such a good formula to use, let's give you a quick recap of some of the other formulas that we've talked about in the past. And if you're not a long-time listener, you may have come across it anyway in your day-to-day dealings with property investment. So let's start with gross yield. And it's really simple to work out your gross yield on any property, whether you own it or one you're looking to purchase. You take the total amount of income, not profit, income generated from your property. And the income is normally rent. So you take the total amount of rent and then you divide it by the property value. And then you'll get your gross yield. So why would you use gross yield? Well, gross yield is a great tool to help you to compare it against other investments really quickly, because it's quite simple to work out. So if you go, okay, my property I'm looking to buy is 100k and it's £500 rent a month. Well, that £500 rent a month is £6,000 a year. So I divide that and see I've got a gross yield of 6%. You don't need to be Carol Vorderman or even use a calculator in most circumstances to roughly work out your gross yield. And it's a quick tool to help you assess your potential property or current property against others. Now, as a quick tool, it's fine, but it is lacking because what gross yield doesn't take into account is the costs associated with your rental income. So, for example, if you had £6,000 worth of rental income, but you, for some reason, had a lot of costs associated around that income, and you only made £1,000 worth of rental profit, that's not great. Whereas you could have something with a gross yield of 5%, but only 2% costs, so you'd have a 3% profit. Now, what I'm actually referring to there is the next formula, which is net yield, which is where you take your rental profits, deduct any costs like mortgages, service charges, property management, insurances, whatever you want to use and choose, and it is up to you. There is no hard and fast rule on what you should measure. You take all those costs off, and then you find your net income, and you get your net income, and you divide that by the property price, and that is your net yield, which is a bit more useful than gross yield. Requires a bit more effort as well, because you have to go and find out all your costs. So that's why there is a place for gross yield, because it's a quick snapshot tool. But a better tool for analysis, if you're assessing an investment opportunity, is net yield. But then, Rob, on the podcast, we've talked in the past that while net yield is useful, we feel there's another formula that is superior to net yield.
That's right, because whereas net yield has more information than gross yield, it also still leaves something out. And that something is if you're using a mortgage, because the net yield formula ends up taking the amount of money you eventually make after your costs and divide it by the cost of the property. But if you're using a mortgage, you haven't put in the cost of the property. You've put in your deposit plus whatever other costs you've got. So what the ROI formula does is exactly the same as net yield. It takes your rental income, takes off all your costs, and ends up with your profit. But then instead of dividing it by the price of the property, you divide it by the amount of money that you put in. That gives you your return on investment, which makes sense because it's by taking your return and dividing it by the investment that you put in. So if you were buying with cash, you weren't using a mortgage at all, your net yield and your ROI would be exactly the same number. So this isn't so relevant if you're buying with cash, but if you are using a mortgage, then it's really important because ROI gives you a true measure of how hard your money is working for you. Or does it, Rob? Because there's one very important thing that none of these formulas include.
That's right, Rob, because it doesn't include capital growth at all. There is a formula called the total return formula that looks at everything. So it looks at your rental profits plus your capital growth, and you divide that by the cash you put in, and that gives you your total return. So you get to really assess how your property has performed. And when you look backwards at your investments, look at the past, then total return is hugely useful because you can see how it's performed over time. You can take into account capital growth as well because it's really important that you do. It is in nearly all cases, the biggest source of return you'll get from your property. So you're doing you're doing your investment no justice if you ignore it completely. So you should consider capital growth. But what about when you look forward? Then you are only estimating the capital growth. So that's where some people feel uncomfortable about using it. But again, for the same reason, when you take on an investment, the majority of the wealth you'll create through that investment will be through capital growth. So while you may not be able to hang your hat on those numbers, it's absolutely crucial that you consider it. Now, you may be dismissive of this idea and say, no, that's all speculation. But let's give you some examples of the impact of ignoring capital growth.
Okay, Rob, so I've got a choice of two properties that you could buy. Both of them cost £200,000. So you could either buy property 1, which has got an ROI of 7%, or you could buy property 2, which has got an ROI of 4%. Which one would you like?
Oh, go no further, Rob. It's obviously property 1 that I want to purchase here. Please, can you send the contract over?
Oh, Rob, you're being too hasty because you have ignored the possible of capital growth. You should have asked me whether both of these properties will perform exactly the same in terms of their growth, because they won't. So property 1 has got an ROI of 7%, and because I can see the future perfectly, I know that next year it's going to achieve capital growth of just 1%. So that's a £3,500 rental profit, plus a £2,000 increase to the capital value. Now, to keep the maths easy, let's assume that you're buying this property with a 75% mortgage, and we'll ignore taxes and costs and things like that. So these numbers are not accurate, they're simplified to make a point. But if you do that, then your total return, the £3,500 rental profit plus the £2,000 growth, divided by the £50,000 deposit you put in, gives you a total return of 11%. But property 2, which apparently you're not interested in, has only got an ROI of 4%, but it's going to grow by 3% next year in terms of its value. That would give you only £2,000 in rental profit plus £6,000 in growth. Divide that £8,000 by the £50,000 you put in, and you get a total return of 16%. So it's only over a single year, but a huge difference in terms of the amount of money that you'd eventually walk away with, and a huge difference in total return. If you had opted just for the property that generated you the highest rental profit, you would have done yourself out of a fair bit of money. Now, that doesn't mean that you should buy property 2 every single time. It's going to depend on your goals. If you are a purely income-focused investor, what matters to you is getting as much cash in your pocket as you can right now because you want to accumulate that rental income and use it to quit your job or reduce your hours or whatever, then actually, even if you end up making less money in total over the long term, you might prefer to have the property that puts the most money in your pocket right now. But if you are looking at property as a long-term investment and you're interested in that property having the biggest impact on your overall wealth over the long term, then clearly you have to factor in capital growth.
Now, as we've already alluded to, you can't predict what future growth will be. But I think it's fair to say that you can have a decent idea of which properties will perform best based on the location or property type, for example. So, to bring it into real-world terms, at the moment, if you had a property in Liverpool, a market that is bouncing, but affordability is still at a really good level and lots of investment happening in that area, then you would expect capital growth over the next few years to be pretty good. Compared to maybe an area we've talked about previously, like Barrow, which is kind of north-northwest, if that was such a thing, very close to the border, kind of tucked out of the way. If you were assessing a property there, you would possibly come to the conclusion that you wouldn't expect as much capital growth to take place. So, if the property in Barrow had a better yield than the property in Liverpool, does it mean that the property in Barrow is a better investment? Well, based on the total return formula, possibly not. As Rob said, it will come down to your goals and what you want to achieve. But if creating wealth through property is something that is paramount to you, then using the total return formula is critical.
So now we know what total return is, and we've made a case for why you should consider using it. Let's look at how to use it. And we can look at both of the use cases we've talked about, looking backwards to see how your investments you already own have performed, and looking forward to see how a property that you're considering buying might do for you in the future. So let's start by looking backwards and trying to answer the question, what did this property do for me last year? And of course, that doesn't have to be over a period of a year. It could be a period of multiple years. And that actually could be pretty valuable because then you can really see, well, how has my property portfolio done for me compared to other investments I could make? If I'd taken the same amount of money and stuck it in the stock market instead, where would I be? You'll be able to answer that question by using total return. So to do that, you need to calculate each of the elements. Two of them are really easy, one of them less so. So you know how much money you put in the first place to buy the property. That's easy. You should also know your rental profit because you'll know how much rent has come in and you'll know what your costs on that have been. You'll then need to work out how much the value of the property has grown over the period of time in question. And of course, depending on your strategy, that growth may have come from the market, just giving you an uplift, or it could have come from your own efforts as a result of some improvements that you've made. But either way, you need to know what growth you've had. Because to really know for sure, you would need to know what you'd be able to sell your property for today. And the only way to know that is to actually sell your property today, which you probably don't want to do. So you need to come to an estimate of what your property is worth today. One is you may have had a recent mortgage valuation. If so, they will have had a professional valuer put a value on your property, and that's something you can use. You could also get estimates from sites like Zoopla. So if you put in your property's postcode and details, Zoopla will give you an estimate of what that property is worth. It'll normally give you a number and also a range and tell you how confident it is in that number. Now, this data has got better over time. It used to be pretty dreadful. It now can be pretty good, but it rather depends on how many sales there have been nearby and how similar your property is. So if you've got a flat in an identical block of 200 and there have been 10 sales in the last year, you're probably going to get a pretty good number. If you've got a totally unique farmhouse in the middle of nowhere, there's probably going to be a high degree of error. The other thing you can do is just get your own comparables. So if you've got your Rightmove alerts set up for your area, then you can see what properties are being marketed for, what they're being sold for, and get your own sense of what your property would be able to achieve. None of these numbers is perfect. The mortgage valuation is probably going to be skewed to the low side, and your own comparables are probably going to be skewed to the high side because you're going to want to give yourself a good number. So you could use more than one of these and take an average. So it is a bit of effort, but after doing those things, you'll know the three components. You'll know how much you put in, how much rental profit you've made, and how much your property has grown. That will give you what you need to give you your total return for that period.
So, looking backwards, with a bit of work, it's quite easy to assess how your property has performed. But what about when you look forwards? How do you estimate growth for the future? Well, as you'd expect, it's tougher. It's not as easy to do. And you are going to have to speculate. But there's speculate where you can just pick a number out the air because it sounds nice and it's what you'd like, or there's speculating with a bit of thought. And that's what you need to do. You need to do research. You need to be looking at how an area is trending right now. Is it on the way up? Has it been going up for a long, long time? And is it really heated? Is it an area that's achieved no growth at all over the last few years and that trend may continue? Or is it an area that's about to pop? Now, that's difficult to assess. But luckily, we've created a course that's absolutely free for you to take advantage of on propertyhub.net. And it's called How to Pick the Next Property Hotspot. And we take you through the steps that we go through to assess how an area might perform in the future. And is that assessment any good? Well, actually, we give ourselves a hard time on the Property Podcast, but our predictions of areas to invest in over the last however many years has been pretty good, and we've got a great track record of giving you a heads up of what area is about to do well over the next 12 months. And each year we refresh those predictions. You can find those episodes on YouTube or in the feed of the podcast where we predict each year how the market's going to do. So just search on YouTube for the best places to invest in 2021 or on Google and you'll find us. We've done other videos on YouTube, like areas that are underrated that you can invest in because we feel they've got potential as well. So obviously you're taking advantage of the Property Podcast, but don't let yourselves miss out on other education that we're putting out there. Check out Property Hub University, which is on the Property Hub website, and check out our YouTube channel. Just search for Property Hub UK. Make sure you subscribe. And if you don't want to miss any of those videos, turn on the notification bells so you'll get updated when a new video is released. So it is going to come down to research. It is going to come down to knowledge. It is going to be looking at trends currently that are taking place and just your overall gut feel of how you think that area will perform once you gather all that information. As I've already said, there's no exact science, and anybody who tells you that there's a tool to predict future capital growth is someone who's telling fibs. So you might not want to believe what else they say around property investment, but you can come up with a reasonable best guess of how something will perform. And of course, you've got the 18-year property cycle to help you understand what the overall market is likely to do. And yes, we've done numerous podcasts on that subject and a course on Property Hub University as well.
So there you go, over 450 episodes into the Property Podcast, and we're giving you an entirely new formula that we've never mentioned before. Really though, this is just formalising something that we've said for a long time, which is that the income that you get from a property is really, really important. But if you're investing in property to grow your wealth over the long term, you can't ignore capital growth because it is such a powerful source of returns. What total return does is give you a way of measuring that. Measuring it is never going to be as straightforward or as accurate as just measuring the rental side. You absolutely can never, especially when looking forwards, put a number in a spreadsheet and say, oh yeah, this is what will happen. But by going through the exercise of trying to calculate it, it encourages you to think about both components of your investment, the potential income and the potential growth. None of this is to say that this is the only way you should be measuring your investments from now on. Gross yield, net yield, and ROI all still absolutely have their place. They're all going to be numbers that you'll want to calculate from time to time for different purposes. Think of total return as just another tool in your tool belt. And its superpower is it gets you thinking about both of those sources of return in your investment. And by considering your investment as a whole, you're far more likely to make the best long-term decisions for you. Now, we can't end an episode of the Property Podcast without giving you a Hub Extra. It's that part of the show where we give you a little bit more before we go. Sometimes it's a resource, sometimes it's a quote, sometimes it's a tool. Today, Rob, it's a book.
It is a book, Rob, and it's a book that I'm just finishing off right now, so I feel ready to give a review on it. It's called No Filter, The Inside Story of Instagram. It's by Sarah Freer. It's a really interesting book. I was reluctant to pick this one up because I've read Hatching Twitter before, I'd watched The Social Network, and while the books and the subsequent film were really interesting, it was really centered around scandal. And I thought, oh, is this going to be a carbon copy, but just for Instagram? And yes, this book does have some scandal, some upheaval, as you would expect from any fast-growing business that's acquired by a Goliath in Facebook. For those of you who don't know, Instagram was only about 18 months old when it was acquired by Facebook for $1 billion, which at the time was seen to be a crazy amount of money. However, history suggests that that was a shrewd investment by Mark Zuckerberg. Now, why I really like this book and why I'm recommending it is that I found it really interesting to understand the origin story of Instagram, what it was intended to be, how people have used it, how the world has been changed by Instagram, and its impact on us as a society. Now, if you don't use Instagram, then you may think, oh, what impact? But I didn't really think about the impact it made until I'd finished the book, because it is astonishing the social impact that this one app that we have on our phones, that many of us have on our phones, has made on society. So yes, it's a business story, but it's also how that business has done. But for me, it goes a bit further, and it really gets you thinking about Instagram, social media in general, and how it's helped society in some cases, but really hindered us and is affecting us negatively in others. I'm not going to give this an all-out endorsement. It's not a page turner. I think you have to have a passing interest in Instagram or business or social media in general to really enjoy this book. If you're struggling to find a book right now, then absolutely give it a go. It's not a thriller, but it is really interesting, and it's kept me engaged throughout, and it's made me think, and books don't always do that. So I will recommend it. Not an all-out, you must go and get this book now, but if you're struggling for a book or those subjects interest you, then consider No Filter.
Well, that is us done for another episode of the Property Podcast. Hope you enjoyed it, and let us know what you think. You can find us on all the socials at Property Hub UK. We will see you again for Ask Rob and Rob on Tuesday, and then we'll be back again with another wonderful episode of the Property Podcast. As always, same time next Thursday. So we'll see you then. Bye-bye.
Bye-bye.